Robinhood just became the U.S. government's official broker for 60 million kids. But the market completely ignored that today, mostly because their core retail traders, well, basically took a nap this quarter. You're listening to Earnings Unscripted. It's April 28th, 2026, and we are unpacking Q1 results for Robinhood, ticker HOOD. And, Miro, this feels like a serious momentum break. Total net revenues fell all the way back to $1.07 billion.
Yeah, it's it's a harsh reality check. The whole Q4 trading mania is definitely over. I mean, top line is down 17% sequentially, and diluted earnings came in at 38 cents a share. So they actually missed the analyst estimate of 41 cents, which is it's a 42% sequential drop from what they posted just 3 months ago.
Okay, quick reminder before we start predicting the apocalypse. This is definitely not financial advice, just two friends sharing personal opinions, so please do your own research. But seriously, a 42% drop in profits. I know crypto and options cooled off, but a 20% plunge in transaction revenue just seems so fast.
Well, volatility died down. And when retail investors get bored on a retail trading app, the platform bleeds. Plus, their net interest revenue contracted roughly 13%. So lower short-term rates are officially biting into their cash yields now. And the tape entirely reflects this. I mean, they were holding steady in the $82 range right into the close today. Then the print hit and the stock just cratered. It dropped over 11% in the after-hours session, kind of flattening out around 74.
Ouch. And I saw the margin got squeezed too. Their adjusted EBITDA margin compressed from 59 down to 50. But here is the absolute paradox. They still brought in $17.7 billion in new net deposits. So their 27 million funded customers are actively putting fresh money into the app. They just aren't trading with it?
Right. It's becoming a parking lot. Users are essentially treating Robinhood like a digital bank right now, which is fine for stability, but Wall Street prices this company like a high-growth casino. If you only pull in $623 million from actual trading activity, that valuation multiple just starts to crack. Although, honestly, the market is so hyper-focused on the top-line miss today that I think everyone is completely missing the structural plumbing they just altered on the balance sheet.
Oh, right, the cash sweep thing. They moved billions of dollars around internally. All right, let's get into the details.
Exactly, because this is the stuff that rarely makes the headline but fundamentally changes how the business operates. They internally reclassified $6 billion of uninvested customer cash, the sweep cash, and they moved it right onto their own balance sheet.
Just to make sure we are clear on why that matters, usually that sweep cash is parked off-site somewhere, right? Like sitting at various partner banks.
Right, yes. They historically ship it out to program banks to earn a yield, but now they are keeping it in-house as free credit balances to directly fund their own margin lending book.
Wow. Okay, so they're literally just cutting out the middlemen.
Pretty much. They have an expanding margin book, and it requires capital. So rather than borrowing from outside trusts, they use their own users' cash to fund other users' trades. It is classic banking logic applied to a zero-fee brokerage model. They capture the spread without paying for external credit.
It is very grown-up treasury management for a company we usually associate with meme stocks.
I know, but it shows you how they're optimizing behind the scenes. They're getting incredibly aggressive about capturing every possible basis point of yield inside their own walls.
Well, speaking of aggressive, we really need to talk about the dividend feature because this actually blew my mind when I read it. They built a mechanism to basically time travel for retail investors.
The early dividend payouts.
Yes! So historically, users would complain because Robinhood paid out dividends in the evening while traditional brokerages did it in the morning. Mm-hmm. So the product team looked at this and said, let's not just beat them by 12 hours. Let's beat them by 3 weeks.
It is actually a brilliant piece of plumbing. They realized the dividend record date is usually weeks before the actual cash payment date. So if you hold the stock on the record date, you're legally guaranteed that money.
Right. And Vlad actually spelled this out on the call. He said, and I have it right here, he said the dividend record date is up to 2 to 3 weeks before the dividends are paid out typically. We saw an opportunity to give your dividends an average of 17 days or 2 to 3 weeks earlier.
which is huge. They are literally fronting the cash. And for passive investors, the ones they call dividend hounds internally, that is a massive liquidity advantage. It locks those users completely into the ecosystem.
Dividend hounds. That is amazing. But it really is a fascinating psychological hook, because once you get used to receiving your cash 3 weeks early, you are definitely not moving your account back to Charles Schwab.
No chance. And it puts legacy brokers in a very awkward spot. They do not have the modern tech stack or, frankly, the risk appetite to just float millions of dollars in early payments. Robinhood is weaponizing their balance sheet to build a moat.
Okay, so they have the dividend hounds locked down, but what about the active traders? Because they also just got a massive regulatory gift, didn't they?
Oh, right, the PDT rule. Yes, FINRA finally killed the pattern day trader minimum.
Which means you no longer need $25,000 in your account to day trade freely. That used to be the absolute biggest friction point on the app. People would get flagged, their accounts would freeze.
It was a completely vestigial regulatory block. And Vlad was pretty unfiltered about it. He essentially called out this old notion that your account balance dictates how sophisticated you are. But for Robinhood specifically, this removes a ceiling on velocity.
Because a huge chunk of their 27 million funded users are undercapitalized. They just did not have the 25 grand.
Exactly. So historically, those users had to flee to offshore exchanges or sketchy crypto platforms just to trade actively. Now that friction is entirely gone. So if volatility returns, the transaction volume they could capture from their existing user base is enormous.
So under the hood, they are actually building a much more efficient, highly retentive machine between floating the dividends and unleashing the day traders. But it still does not completely mask the fact that current revenues just took a massive hit. So where does this leave them heading into the rest of the year?
It leaves them paying a very expensive toll to cross the bridge into the next cycle.
You are talking about the Treasury deal, the Trump accounts we mentioned at the top of the show.
Right. So management just raised their full-year expense outlook by $100 million purely to build that infrastructure. Their new operating expense ceiling is now over $2.8 billion. That is a heavy, heavy lift to drop on investors all at once.
Which is really tough to swallow when your core trading revenue just dropped 20%. But I mean, if you step back, Vlad literally said they're getting their technology in front of 60 million kids. That essentially solves their entire top-of-funnel customer acquisition problem for a generation.
It does, but look, Wall Street is historically impatient. The CFO noted this contract is on a cost-plus basis with a small margin. So this is not some instant profit engine. It is basically a strategic Trojan horse.
A Trojan horse funded by the U.S. Treasury. I actually love that. So they are taking a near-term hit to margins for long-term dominance. Do they see a rebound coming in the summer?
The guidance suggests they do. They're expecting top-line revenue around $1.2 billion next quarter and an EPS recovery to 45 cents. And they mentioned April transaction volumes are trending toward their second highest month ever.
Which makes total sense if those unleashed day traders start flexing their new buying power. So I guess the big watch item is whether they can stomach that massive build cost without breaking the model.
That and making sure the multi-state legal war over their prediction markets does not explode. Several state gaming commissions are sending injunctions right now over sports betting claims. If Robinhood loses that fight, billions in monthly event contract volume just vanishes overnight.
Right, because it simply would not be Robinhood without a looming regulatory cliff to keep things interesting.
Naturally. It keeps the accountants from getting bored.
Well, they have AI doing most of the paperwork now. Anyway, I think we have officially unpacked this one. Thanks for the reality check, Miro.
My pleasure. See you next time.
Bye, everyone. If you want these earnings breakdowns to just show up in your feed, feel free to follow the show. And just as a quick transparency note, this project is generated using AI tools that help us synthesize hundreds of pages of financial filings into the conversation you just listened to. We would absolutely love to hear your feedback or any specific ticker requests you might have. So shoot us an email at earningsunscripted@datamadness.ca or find the X link down in the show notes.